Hey, welcome to The Explainer. Today, we're going to crack open one of the most powerful metrics in all of real estate investing. Seriously, it's a single number that can tell you almost everything you need to know about a property's financial health. It's called the operating expense ratio, and trust me, you need to understand it.
All right, let me throw a scenario at you. You've got two properties to choose from. They both pull in the exact same amount of money, $500,000 in gross income. So which one's the winner? On the surface, they look like twins, right? But as you're about to see, the most important piece of this puzzle is totally missing.
Because here's the thing. What really matters isn't what a property makes, it's what it gets to keep. Without knowing the operating expenses, that big, shiny income number is pretty much meaningless. It tells you zip about the actual profit, the net operating income, or NOI.
So how do we solve this thing? How do we figure it out? Well, we need a tool, a metric that measures financial efficiency. And that tool, my friends, is the operating expense ratio, or as we call it, the OER. This lets us do a real apples-to-apples comparison even between totally different properties.
To put it really simply, the OER tells you exactly what slice of your income pie gets eaten up by all the day-to-day costs of just running the building, before you ever see a single dime of profit.
And the formula? It's beautifully simple. You just take your total operating costs over a certain period and you divide it by the income the property brought in during that same time. That's it. The result is one powerful percentage that tells you so much about how efficient that property really is.
This is my favorite way to think about it. A property that makes a ton of money but has a terrible OER, that's like a gas-guzzling supercar. Yeah, it looks cool, but it is incredibly inefficient. A property with a lower OER, well, that's your fuel-efficient hybrid. It squeezes every last drop of value out of every single dollar of income.
And this chart just lays it all out, plain and simple. An OER of 40% means that for every dollar that comes in, 40 cents goes right back out to cover costs. And the other 60 cents, well, that's your profit. That's your net operating income. The big takeaway here is so important. A lower OER means a bigger slice of the pie for you.
All right, so we know the formula is expenses divided by income. Simple enough. But which expenses actually count? This is where a lot of people get tripped up. So let's get crystal clear on what's in and what's out of the calculation.
So what's in the calculation? Basically, it's all the routine stuff. The day-to-day costs of keeping the lights on and making sure the property runs smoothly. We're talking property taxes, insurance, management fees, any utilities the landlord pays for, and all that regular upkeep. These are the costs of operating the asset.
Now, what's not included is just as important. Your mortgage payment? Nope. That's called debt service, and it has to do with your financing, not the building's performance. What about a brand new roof? That's a capital expenditure, a huge upgrade, not a routine fix. We leave these items out so that the OER stays laser-focused on the operational efficiency of the building itself, no matter who owns it or how they bought it.
Okay, one last critical detail on the income part of the formula. This is kind of a pro tip. Do you use the pie-in-the-sky potential income as if the building were 100% full, or do you use the cash you actually collected? Well, the pros use the actual cash. It's called effective gross income, or EGI. And it's just a much more honest and realistic way to look at a property's efficiency.
So now that we know how to calculate OER, you're probably asking, okay, so what's a good number? And the answer is, well, it depends. A good OER isn't some universal magic number. It is all about context. Context is king. Just look at this. It's wild, right? An industrial warehouse might have an OER of like 20%, but a hotel could easily be over 70%. Now, that doesn't mean the hotel is a bad investment, not at all. It's just a totally different business model with massive operational costs, like daily cleaning, tons of staff, marketing. You get the idea. You can't compare them side by side.
So why the huge difference we just saw? Well, a major reason is the lease structure. In something called a triple net lease, the tenant pays for almost everything: taxes, insurance, maintenance. That means a super low OER for the owner. But in a gross lease, the landlord covers all those costs, which naturally leads to a much, much higher OER.
And hey, it doesn't stop there. An older building? It's probably going to have higher repair bills. A really sharp management company can find ways to save money that a lazy one would miss. And of course, things like property taxes and utility rates can be totally different from one city to the next. You have to factor all of this in.
Okay, so we've defined OER. We've explored all its little details.
But why? Why are we so obsessed with this? Because this, right here, is where the magic happens. This is the aha moment, where we connect how efficiently a building runs directly to how much that building is worth.
It all starts with this simple, beautiful logic. Every single dollar you can save on operating expenses, say by putting in LED lights or finding a better insurance deal, that dollar flows directly to your bottom line. It's a one-for-one increase in your net operating income.
And here is the absolute core of commercial real estate. In this world, value is fundamentally tied to income. The higher your NOI, the more someone else is going to be willing to pay you for that property someday. It's that simple. Higher NOI equals higher property value.
This right here, this is the value add playbook. Smart investors don't just buy buildings, they buy opportunities to run them better. By strategically lowering those expenses, they bump up the NOI, and by doing that, they literally force the property's value to go up. Managing your OER is one of the most direct ways to build wealth in real estate. Okay, so now you understand just how powerful the OER is. Let's weaponize that knowledge. How can you use this to protect yourself and to spot potential problems when you're looking at a new deal?
These are the warning signs you've got to look for. If a property's OER is way higher or way lower than everything else in the area, you have to ask why. Is it just managed poorly? Or worse, is that number artificially low? You know, a classic seller's trick is to put off all the major repairs, which makes the expenses look great today, but leaves you with a mountain of bills tomorrow.
So here's your action plan, your 3-point sanity check. First, do not accept a one-year summary. Demand at least 3 years of real financial statements so you can see the trends. Second, benchmark it. Compare that OER to similar properties right there in the same neighborhood. And third, verify. Get a thorough property inspection and make sure that pretty low expense number isn't hiding a world of hurt.
And really, that's the ultimate question that the OER forces you to answer. It's not just some number on a spreadsheet. It's a story about a property's past and a really important clue to its future. Learning to read that story, well, that's the difference between being a passive owner and being an active investor who truly creates value.